Thanks for clicking into the video again. Frankly, the video conference that we do like this one is the easiest way to communicate. By the time we get thoughts into writing, put it in an envelope, put it in the mail, the market has just bypassed us into a whole nother realm. Things are moving so quickly, so forgive me. I'm not running a popularity contest. I'm just trying to communicate. The problem with the markets, let's take a good hard look here. First of all, the virus, the epidemic, and government's response to it by closing businesses. All of this has a tremendously negative impact on the economy. Some economists are saying 10 to 12% negative for a quarter. I don't know, but it's not good when people stay home, when businesses are forced to shut. And that is the genesis of this decline, but it's much bigger than that. We've always commented in our commentaries and indirectly to most of you about the debt problem for the world, not just the U.S. And this debt balloon is massive. It involves all kinds of credits, mostly bad. About 60% of the bond market is junk bonds, meaning that companies don't have enough positive cash flow to cushion them to pay the interest and to pay the final payment on these bonds. So the credit ratings have been low. And what has been happening is there's a big spread. The difference between a no-risk bond, which is treasuries, and other bonds, the interest spreads between them usually tell you how critical markets are. And the bond spreads have just ballooned. In fact, I heard talk this morning about the Federal Reserve considering buying corporate bond exchange traded funds. We would call that stupid, frankly, a mistake. But if they want to do it, they do it. Why would they bail out substandard bondholders? I don't think it's going to happen, but all kinds of considerations are going on. The latest oil production agreement between Saudi Arabia and Russia, where they're just going to pump as much oil as they can to try to drop the price of oil to bankrupt our fracking industry, is a big problem. And it overlays not only the virus, but it overlays the debt balloon, because most of our fracking industry has been put in place by borrowed money. And the borrowings, if frackers cannot make money under $50 a barrel, oil hit $22 a barrel today. So it's a matter of time till we start closing up that entire industry and perhaps bankruptcies start to occur. This is thrown on top of the virus, thrown on top of the economic chasm that we have. So we've got a rather serious situation going forward. We see signs, frankly, of a deflationary depression, not unlike the 30s. And I don't mean to scare you, but the signs are there. Now, whether we are going to enter into that kind of an environment or whether we're going to be able to fly over that kind of an environment and reassume good markets, good economy, and all of that is unknown. We have to watch this thing day by day. The key to whether we sink into that mire or succeed in going around it or over it lies in the duration of this epidemic. And I would put it to you this way. If we're able to get by this virus panic and the virus passes within weeks, 3-4 weeks, this is a buying opportunity. However, if the virus takes months, creating a widening of this ditch that we have to get over, I think it could be lasting and could be very serious. So we stand at the helm, watching, monitoring this thing daily in the hopes that we can be ahead of it. And our position right now for most portfolios is very, very conservative, featuring cash and U.S. Treasuries short-term and much higher weightings than common stock. The common stock portion is way down. So we wait day by day, and that's the nature of what we do. So someone called from Honolulu to see if we're in a critical kind of a profession that is allowed to open in Hawaii, and I'd say we're pretty critical. But anyway, we will keep an eye on it, and keep you posted, probably by more videos.